2019, question number 4. And the question reads, Adam Musa operates a manufacturing business, trading as AM Manufacturers Enterprises. The foreign trial balance related to his business as at 31st of December 2018. So we're given a trial balance there. Then we have additional information about all the way to note number 8. So what are we required to do here? We are required to prepare Part A, the manufacturing account for the year which ended 31st of December 2018. Then from there, we also required to prepare Part B. We are required to prepare the income statement. Part C, we are required to prepare the statement of financial position. So taking into account, we were able to do the first part. That is, we were able to prepare the manufacturing account. So I want us to go straight to Part B of the question. To Part B of the question. And basically, we are required to prepare the income statement. We are required to prepare the income statement, which is basically for the year, which ended 31st of December 2018. So remember, this particular business here, though it is a manufacturing business, this is a sole proprietorship business because from the information which we have in the first paragraph, we are told that this is a business operated by Adam Musa. So this is a sole proprietorship business. And therefore, what you are preparing here is the income statement of a sole proprietorship business. Sole proprietorship business. So I think we can go straight and prepare this. Let's prepare this as required by the examiner here. So here we need to have 2 columns. And I hope you can see that our figures in the trial balance there are in thousands of shillings. So we need to have 2 columns there. So how do we prepare this one? We always start by recording the sales. So where do we have information about the sales? This one, we have it in the trial balance, and automatically it should be on the credit side of the trial balance. So I hope you can be able to see the sales. It is somewhere below the provisions for depreciation, somewhere in the middle of the trial balance. And that is an amount of 104,665. And then to this, we said we need to check whether we have sales return or basically the return inward. Do we have sales return or return inward in that particular question here? Sales return or return inward, Betty? Charity, can you see sales return? I can't see any. So meaning that our net sales remain the same, 665. Okay. So having that as our net sales, we proceed and basically we compute the cost of our sales. So how do we compute this particular cost of sales? We start by having the opening inventory. And remember, in this case, the opening inventory which we have here is basically the opening inventory for the finished goods. That's what we say. When preparing the income statement, we use the opening and the closing inventory of the finished goods because the information about the raw materials and the work in progress, basically we use them when preparing the manufacturing account. So therefore, we go back to the trial balance and basically we take the opening inventory of the finished goods. And I hope you can see that in the trial balance down here. Opening is inventory of the finished goods, and that one is given 2,400. And then to this, what do we add? Do we add the purchases? No. These are manufacturing business. A manufacturing business, we say, basically it sells what it manufactures. A manufacturing business, therefore, we say we don't have purchases here. Instead of purchases, we record what? We record what? We record the cost of goods produced, or basically the transfer price. The cost of the goods produced, or what? The transfer price. Jenny, you're saying what? You're saying this is the gross sales? Jenny, you think that is gross sales? No, that one cannot be gross sales, Jenny. So what is the difference between gross and the net? Jenny, in note number 4, we are told inventory of the finished goods, which is basically 4,000. Forward 4,000. So in that case, we will be able to get the cost of sales, which we take to the last column, which we take to the last what? To the last column. So can we get that value? Can we get that value, the cost of sales? So we have 24 plus 89,687.5 minus 4,000. And basically, we are getting a value of what? We are getting a value of 88,087.5.
Check whether
0.5.
Santa Claus is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly, That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year one, you'll receive 300,000. In year two, you're getting 550 or receiving paying or 550. Year three, 600. Year four, 700. Maybe let's say year five, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year one and year two, or period one and period two, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year one and year three, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. Rate of return. Rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do you have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus R power n minus 1 over R. So here you say 16,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it.
(2021) all the way to 2024. So basically, these are a very good question on leases. These are questions are borrowed from another paper, paper called FSA, Financial Statement Analysis. This is a paper which is done in CIFA, and basically this was a question from April of 2025, specifically question number 5B. Now, in this case, we are told that this company, which is called Perry Limited, entered into a lease, and this company, Perry Limited, leased an item of machine from a supplier. So automatically, Perry Limited is the lessee, is the company which was given the right to use an asset, whereas now the supplier is the owner of the asset. So if you go to the requirement, you're required to analyze the accounting treatment of the above this transaction in the financial statement of who? Of Perry. So in other terms, you're required to illustrate how Perry Limited, who is the lessee, was supposed to account for this particular risk. And remember what we said is that once a company leases an asset, so that company should recognize two items: the lease liability, the right of use asset. But remember, we also talked about two exceptions in relation to that. You may come across that theory question whereby you are asked to give two circumstances, two instances whereby the lessee will not be required to recognize the lease liability and also the right of use what? Asset. So we talked about two circumstances. Number one, we talked about a short-term lease. If you lease an asset for a short period of time, a period which is less than 1 year, you are not required to recognize the lease liability and the right of use asset. Number one is therefore where the lease is a short-term lease. Number two is whereby the lease asset is of a low value. If you lease an asset which is regarded to be of a low value, you are not required to recognize the lease liability and the right of use what? Asset. But this company, Perry Limited, basically on the date the lease commenced, the company needed to recognize two items: the lease liability and the right of use what? Asset. We said always we start by computing the lease liability. We start by computing the lease liability, and basically we compute this on the date when the lease commenced. In other terms, we compute this on the inception date of the lease. So if you go back to the information we have in the first paragraph, the first sentence, this lease was entered into on 1st of December 2020. That is when this company, Perry Limited, leased that particular item of machine. So we need to compute the lease liability. How do we compute this lease liability? We say that this one is equal to the present value of the minimum lease rentals not paid at the inception date. Not paid at the inception date of the lease. Inception date of the lease. Not paid at the inception date of the lease. So we discount those particular minimum lease rentals, but which were not paid at the inception date. So basically, if we go back to the information still which we have in paragraph 1, we are told that this company leased an item of machine for a period of how many years? For a period of how many years? Are we given? Yes, for a period of 4 years. I hope you can see that in the first sentence. So this therefore is the lease for how many years? Is the lease for 4 years. Year 1, year 2, year 3, year what? Year 4. So how are the minimum lease rentals payable? As per the information we have in sentence number 2, we are told the terms of the lease were that Perry Limited was required to pay annual lease rentals or annual rentals of 1.55 million in arrears. In arrears means what? At the start or basically at the start or at the end of the year. Who can tell us? In arrears means what? At the start or at the end? At the start or basically at the end? Yes. In arrears means at the end. So this amount was payable at the end. So the amount which was supposed to be paid at the end of year 1 is 1.55 million, 1.55 million. At the end of year 2, at the end of year 3, 1.55 million, 1.55 million. And therefore, if you check this particular question which you are doing here, you should be able to note that it is different from the other question which we did. I hope you can remember the other question which we did in class the other day, a question which was examined in December 2024. So remember the lease rentals, the minimum lease rentals were payable at the start. So therefore, I want you to see the difference. Rin, I think there was a question which was asked by Rin, there was a question which was asked by Evans. So in terms of the difference, whenever the minimum lease rentals is payable at the start and also at the end, we say there is a difference in terms of how we compute the lease liability. Number 2, how we prepare the lease amortization schedule. Remember, therefore, all these particular amounts are payable at the end. So how do we compute the lease liability? We discount the minimum lease rentals not paid at the inception date. Now, this amount, all of them, you can see they were not paid at the inception date because there is no amount which was paid there. Because we said we discount everything excluding the amount paid at the inception date. So we will take 1.55 million. We multiply this with the present value interest, present value interest factor of annuity, at which rate? At the rate of 13%. At the rate of 13%. The rate of 13%. Then what will be our N here? Our N will be 1, 2, 3, 4. So we are discounting minimum lease rentals for how many years? For 4 years. Yes. So for 4 years. But remember, if this particular amount were payable in advance, so for example, this amount was paid here at the start of year 1. This was paid at the start of year 2. This was paid at the start of year 3. And this one was paid at the start of year 4. What would be the difference? The difference would be our N here. Our N should be 3. Our N should be 3 because we just need to discount what was paid there, and there. So the amount paid at the inception date should not be discounted. Yes. So let's work out this. And I think in our case, we already have this value. We already have this value. Remember, we said, in case the examiner has not given you this is the formula you have to recall. 1 minus 1 plus r raised to power negative n. We divide that with r. So that is the formula you need to remember. But I think in our case, we already have this value here. In the last paragraph, you told the present value interest factor of annuity at 13% for 4 years. This one is given as what? This one is given as 2.97447. So if you work out this using this particular formula, you have 1 minus 1 plus r. Remember, our r is 13% raised to power negative n. That is 4. And then you divide that with 0.13. You should get that value there. You should get that value there. Yes, we multiply that with 15. 50. So what will be our lease liability here? What will be our lease liability? What will be our lease liability? We try to hurry up so that we do at least more questions. What are you getting? So I'm getting a value of 4610. 428.5. Yes, so basically that is the value I'm getting. Yes, I think we can work with that figure right now. Yes, so that basically would be the lease liability. Now we said, even before we move to compute the right of use asset, what do we need to do with this lease liability? We need to amortize it. Before we proceed to compute the right of use asset, can we amortize this? So let's amortize this by basically preparing the lease amortization schedule. There is amortization schedule. There is amortization schedule. So you'll also be able to see that there is difference in terms of how we're going to prepare this with what we did in the other question, simply because these minimum lease rentals are payable at the end. So take into account our lease is basically for 4 years. We need to have 4 years here, or you can have the specific dates when those 4 years were ending. So those specific dates are given in the requirement. If you go to the requirement, so you'll be able to see that you're given those specific dates. The first year ended 30th of November 2021, 30th of November 2022, 30th of November 2023, and 30th of November 2024. So then the next column here should be for the lease liability at the start of the year. The next column will actually be for the interest. The next column will be for the interest, and this one we computed at the rate of 13%. But remember, if these minimum lease rentals were payable in advance, so after the lease liability, the next column should be forward for the cash paid, for the minimum lease rentals paid, if this one was payable at the start. Sasa? Yes, but because it is payable at the end, so the next column should be for the interest. The next column should be for the minimum lease rentals, paid. And finally, we have the lease liability at the end of the year. So that's basically how we arrange our lease, the lease amortization schedule. And therefore, you can see always we interchange these two columns, depending with when the minimum lease rentals is payable. Can you be able to see that difference with what we are doing here and the other question which we did in class? Rin, can you be able to see the difference? Evans, can you be able to see the difference? Yes, I want you to see that difference. There is always a difference in terms of how we compute this one. There is the lease liability, and actually how we do what we present this. So in case the minimum lease rentals is payable at the end, so after the lease liability at the start, what comes next is the interest, and then the minimum lease liability. Yes. So what we start with here is basically the lease liability at the start of year one, and that is basically what we have computed there, which is basically an amount of 4610 for 28.5. So we compute interest, which will be 13% of this, 13% of the opening balance, 13% of this, and basically I'm getting 599, 356 to the nearest whole number. Let's work with that to the nearest whole number. And then the minimum lease rentals, which was paid at the end of year one, is this one, 1550,000. So this one, we said it reduces the value of the liability. So to compute the lease liability at the end of year one, we will take this one, lease liability at the start of year one, we add the interest, we minus this. So in other terms, to compute this, we are taking what? In other terms, to compute the lease liability at the end, we are taking this one, the lease liability at the start, we are adding this one, the interest paid, we are raising the minimum lease rentals paid. So we are taking A plus B minus what? Minus C. Minus what? Minus C. That's basically how we are getting that value there. Sasa? Yes. So let's work out that. So we add 4610 for 28.5 minus 1550. Yes, and basically here I'm getting what? I'm getting 36, 59, 784, 784.5, or let's just work with this to the nearest whole number. Let's just work with that to the nearest whole number. To the nearest whole number, to the nearest whole number, to the nearest whole number, to the nearest whole number. This one should be 9. Let's work with that as 9. To the nearest whole number should be that. Yes. So that will be the opening balance here. 3659, 3659, 785. So we compute interest, which is the 13%. 13%. Basically, I'm getting 475. 772. So the amount which was paid at the end of year 2 is this one, which is 1550,000. And then we compute the lease liability at the end of year 2. So we have 36, 59, 785 plus the interest for 75, 772 minus 1550. Yes. And what are you getting here? My figure automatically is not correct here. Yes, what are you getting? Yes, 25, 85, 557. Yes, so that will be the opening balance here. 25, 85, 557. So we compute the interest as 13%, which will give us 336. 122. The amount paid is 15,000. Yes. So let's work out the lease liability at the end of the year 3. We have 25,85,557 minus 155. Yes, and basically here I'm getting 13,71,679. 679. I hope that is what you're getting. So that will be the opening balance here. Is the opening balance here. And then we compute the interest as 13%. 13%, and basically I'm getting 178,318. So the amount paid there is 50,000. And automatically this one should give a 0 or a figure which is insignificant. So let's see what we have. 178,318. Yes, 1371,679 plus 178,318. Yes, so I hope you can see this coming for around 3, but essentially it should be 0. Should be 0. The reason why you're not getting 0 is because of rounding off. So therefore, that's basically how we prepare that particular lease amortization schedule, basically to amortize our lease liability. Having this 10, we need to move and basically we compute the right of use asset. The right of use assets, and basically the right of use asset, equally we compute this at the inception date of the lease. Remember, the lease commenced on 1st of, this one should be December. It should be December, 1st December of 2020. That is when we are computing the right of use asset. Now to compute the right of use asset, we said we add like three values. Number one, we take the lease liability. There is liability at the inception date, and basically that is the inception date is 1st December 2020. So, and there is liability at the inception date is what you have computed here, 4610 429. To this we said we add any payment made at the inception date, at the inception date of the lease. Do we have any payment which was made here at the inception date of the lease? In our case, we don't have any payment which was made at the inception date. We say that you can only have that payment which was made at the inception date, whereby these minimum lease rentals are payable in advance. So if it is payable in advance, automatically the amount was supposed to be paid at the start, at the inception date of the lease. And then to this we add what? Initial direct costs, which are associated with what? With the lease. The initial direct costs associated with the lease. And I think in this question here, we have some initial direct costs which are associated with the lease. Can you see that? Initial direct costs associated with the lease. Who can be able to see that value? It is within paragraph 1, the last sentence. Can you be able to see this? Abdinasil? Amos, can you be able to see that? Yes. Yes. So the initial direct cost associated with the lease is 570. So we add those two values and we get now something called the rate of use asset. The rate of use asset. So the rate of use asset will be 4610 429 plus 429 570. And basically we get what here? We get 15. Okay, I think we can work with this one as 0.85, though you can't be penalized for that. So that will give us 50, 39, 998.5. Is that what you're getting? Is that what you're getting? 50, 39, 998.5. Yes. So having that, then, the next thing we need to do is basically to compute the depreciation per annum. Remember, we say that this rate of use asset should be depreciated on a straight-line basis at the shorter of two periods. At the shorter of two periods, number one, the lease term basically is the period of the lease. In our case, we know this is the lease for 4 years. And number two, the remaining useful life of the asset, or the remaining economic life of the asset. So we're given that in paragraph 2, we are told the machine had a remaining useful life of 6 years. 6 years. So out of the 2 period, we take the shorter of the, or actually we take the period which is shorter, which is basically 4 years. So we will depreciate this on straight-line basis for 4 years. So to compute the depreciation per annum, we will take the right of use asset 50, 39,998.5. We divide that with 4. We divide that with what? We divide that with 4. So we have 50, 39,998.5 divided by 4. Divided by 4, and basically this will give us depreciation of 12,559. 1259 to the nearest whole number. To the nearest whole number, I think should be 1260. Is it 1260? Yes, 1256,000. To the nearest whole number. To the nearest what? To the nearest whole number. To the nearest whole number. To the nearest whole number. Yes. Now, that basically what is required. But if you check on what the question is requiring, we require to analyze the accounting treatment of this in the financial statement. We said, in such a case, what you need to do is you prepare financial statement extract. You prepare the income statement extract. You show what was supposed to be recognized there in relation to these risks. So we start by preparing the income statement extract. We start by preparing income statement extract. Income statement extract. And remember, you say that in the income statement extract, what the company is supposed to recognize, 2 items. One, we have these interest, and actually we say that this interest should be recognized as part of the finance cost. Number 2, the company should recognize this particular depreciation. So, and actually we are going to prepare this for these 4 years here. The first year added that year's November 2021, that year's November 2022, that year's November 2023, that year's November 2024, like that, 4 years. So at the expenses, our company will recognize 2 items. At the expenses, so we have these interest. You can just refer to it as interest, or you can just include it here as part of the finance cost, because that will be a finance cost. So this will be the interest for the first year, 599, 356. So for year 2 is this one, 475, 772. For year 3 is 336, 122. And basically this one is 178, 312, 318. Yes, the other item which will also be recognized here is basically the depreciation on the right of use asset. The depreciation on the right of use asset, whatever you have here, this one. And basically this one remain the same for 4 years. 1256,000, 1256,000 fair, 1256,000 fair. Yes, so that is basically what our company here was supposed to recognize in the income statement as far as this is what is concerned. So these are basically the values which will be marked. Remember, we have said whatever, or actually we said whatever you have done here, all these are workings. What earn you the marks is what you have here. Sasa? Yes. So therefore, you must ensure that you are preparing these financial statements extracts. So then from there, we can prepare the statement of financial position, statement of financial position extract. Statement of financial position extract. 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 Equally, we will prepare these basically for 4 years. That year, the November 2021. That year, the November 2022. That year, the November 2023. That year, the November 2024. 2024, like that. Now, here in the statement of financial position, how many items will be recognized here? 3 items. One of it, David, automatically the figure which you have in the 1250. Oh, that will give us what? 1260. The 1260, yeah? To the nearest whole number, David. It has got 1260. Is that the position? Yes, I think this one should be 1260. Huh? It should be 1260. Like that. I think that should be the correct value. Is that the case? 1260? Yes, 1260. I think it is our rounding off, which is basically along here. But basically should be 1260. 1260, yeah? Yes, 1260 like that. Yes. So basically 3 items to be recognized here. One of which is the right of use asset. Now the right of use asset, that one we recognize it as part of the non-current assets. So under the non-current assets, we will have the right of use assets. The right of use asset. Now the right of use asset, we recognize it here at the net book value. So to compute the net book value for the right of use asset, we will take the cost, this one, and then we less depreciation for year 1. When it comes to year 2, we take this one minus depreciation for how many years? For year 2. Forward for year 2. No, you don't need to show that as provided you have recorded that as expenses. The person who is marking that will be in a position to see that those are expenses, provided they are at the expenses, because these are an extract. That's an extract. Yes, let's compute the right of use asset, the net book value. So we take the cost, which is 50,39,998.5, and then we minus the depreciation for the first year. This is the depreciation for the first year, which is 1260 x part 4. And basically that will give us what? Will give us will give us 37, 79, 99. Okay, to the nearest number, it will give us something like that. So then year 2, we also do the same. In year 2, you can take this minus that depreciation. Are we together? Yes. So we take, alternatively, you take this minus depreciation for 2 years. But the easy approach is once you have computed the net book value for year 1, to get the net book value for year 2, you take the net book value at the end of year 2, at the end of year 1, sorry, you less the depreciation for year 2. Sasa? Yes, so we will take this, we less depreciation for year 2, which is 1260 x part 4. And basically that will give us 25,19,999. What about there? So we take that value, we less depreciation for year 3, which is 1260. And that will give us a 1260,000. And then here, the net book value will automatically be 0 because it is this minus that. So that's how we compute the value for the right of use asset. Then from there, we said that this particular lease liability, this one should be recognized in the statement of financial position as a liability. But basically, we said this amount has to be split into 2. Part of it will be recognized here as an non-current liability. So under the non-current liability, we will have the lease liability, and still under the current liability, under the current liabilities, we will also have what? The lease liability. We will also have the lease liability. I think I showed you how to split that, how to determine the amount to be recognized under the non-current and also under the current. We said, I think whatever is very simple is first of all to determine the amount to be recognized under the non-current liabilities there. Under the non-current liabilities there. So we said the amount to be recognized as a non-current liability at the end of year 1, that is this year, we take the lease liability at the end of year 2. So the amount to be recognized as a non-current liability in year 2, we take the lease liability at the end of year 3. At the end of year 3, we take the lease liability at the end of year 4. At the end of year 4, the lease liability at the end of year 5. So therefore, in year 1, the first year here, the amount to be recognized as an non-current liability is this one. So which is 25,85,557. In year 2 is what we have here, 13,71,679. In year 3 is basically 0, and also in year 4 is 0, like that. Yes. Then from there, to determine the amount to be recognized as a current liability, we say this amount payable within 1 year. And therefore, we said we take the decrease because the decrease basically is the amount which has been paid. The reason why liability reduces is because there was a payment which was made. There was a payment which was made. So let's get the difference here between these two values here. We have 36, 59, 785 minus 25, 85, 557. And basically we have a decrease of 10, 74, 228. I hope that is what you're getting. David Reiser, is that what you're getting as the decrease, as the difference between those two values? Is that what you're getting? Yes. So then we move to year two. Year two, basically we get the difference between these two values here. The difference between those two values there. That is the 25, 85, 557, 25, 85, 557, and this one minus 13, 71, 679. So basically that will give us an amount of 12, 13, 878. Yes. And then now in year three, we get the difference between this. Remember, there is liability there is 0. So the difference between those two values there is what? Is 13, 71, 679. And automatically in the last year, the lease liability is what? Is 0. And the lease liability there is 0. The lease liability there is what? Is 0. Is what? Is 0. So that is it. That what was required in that question. So what will earn you the 8 marks is basically what we have here. But remember, there is a similar question which we did in your paper 6. That question, the marks allocated there were 10. So meaning that in such a question, you can either be given 8 marks or basically 10 marks. But what I want you to understand is the difference in terms of how we compute the lease liability, how we compute the right of use asset, how we prepare this particular lease amortization schedule whenever the minimum lease rentals are payable at the start of the year and also at the end, because that is the question you're likely to come across. The minimum lease rentals are payable either in advance or in arrears. You must be in a position to compute the lease liability to prepare this one and the right of use asset. Yes. So basically that is it. That what was required as far as that question is concerned. And therefore, I hope that if you happen to come across a question from this topic, the topic of leases, I expect you to score good marks as far as that question is concerned, because I think we have revised from this. Maybe what you also need to do is, can you try to check on how the leases are accounted for by the owner of the asset? The owner of the asset, or basically the lessor, try to remind yourself how that particular person accounts for the leases. Account for the leases. Account for what? For the leases. Account for what? For the leases. Okay. So we have that. We have another small question here. So basically, I want us we switch now to another topic, a topic of financial instruments. So remember, in relation to that topic of financial instrument, we did a number of we covered a number of concepts. The first concept we did was on compound financial instruments. And remember, I say that compound financial instruments are the financial instruments issued by the company. They contain both equity and liability component. And actually, we say once the company has issued a compound financial instrument, as per the requirement of or as per IS 32, the company should split the two components. The company should split the liability component and the equity component. There is this equally a question here I want us we go through. Let me share the same. But there is a similar question which we did in class, which is the same with this. Yes, equally I've shared that question in the class WhatsApp group. I hope it is clear. I hope it is clear. Is it clear? Whatever I've shared in the class WhatsApp group. Is that question clear? Yes, I hope it is. But before you look on that, can we just take a short break of just like 8 minutes? We come back at 9:10, so that we continue with that question. So we just take a short break of 8 minutes, and then we come back up after that short break of 8 minutes. We come back at 9, 10. Yes, so I want us to continue. I hope you're back. I hope you're back. So let's look on these that questions here. Let's look on that particular questions here. So the question reads, that Good Limited issued shilling 4 million 7% convertible bonds on 1st January 2019 par value. So the bond is redeemable at par on 31st of December 2023, or can be converted at that date on the basis of 2 shillings 1 ordinary share for shillings 10 of the bond held. So we are told the prevailing market rate on 1st January 2019 for similar bonds without conversion rights was 9% per annum. And then you're told that all the interest in the year to 31st of December 2019 has been paid. So what are we required to do here? We are required to calculate the amount being included in the statement of financial position of Good Limited in respect of the convertible bonds on 31st of December 2019. So now we say that if you happen to come across this question and you see the word convertible, if, for example, you're told a company issued a debt instrument, and that debt instrument issued by the company happens to be convertible, then we say what you need to remember very fast is that this is a compound financial instrument. This is a compound financial instrument. Remember, we said a compound financial instrument. We said that this is a hybrid financial instrument. In fact, in other terms, it can be referred as a hybrid financial instrument. It's a financial instrument which contains both equity component and the liability component. It contains the equity and the liability component. And we say once the company has issued such a compound financial instrument, as per IAS 32, the company needs to split the two components, the liability component and the equity component. We look from the steps to be followed. First of all, we said we compute the liability component. Number 2, we compute the liability component. So what I want us to do, let's go straight to that question. We go straight to that question. Equally, this is a question I've borrowed from the paper for CFA, financial statement analysis. So this, I think, was from which sitting of CFA? This one from the sitting of November 2020. And this specifically was question number 5A. Question 5A. So we are told this company, which is called Good Limited, our company did what? Issued. The company issued 7% convertible bonds. So take into account we have the word convertible. I'll say that this one is a compound financial instrument. Yes. So therefore, that is very important. That if you happen to come across maybe a question and you're told a company issued some debt instruments and which are convertible, like convertible bonds, convertible loan stock, convertible debentures, you need to remember that that is a compound financial instrument. So therefore, this we can say this is a compound financial instrument and should be accounted for. In accordance with what? In accordance with International Accounting Standard number 32. Remember, I said this standard, International Accounting Standard number 32, basically requires that once a company has issued a compound financial instrument, the company should split the two components, the liability component and the equity component. So the first thing we do is to compute the liability component, and then from there we proceed and we compute the liability component. So therefore, step 1 is basically to compute the liability component. And actually, we compute this liability component on the date of the issue. When were these convertible bonds issued? We are told in the first paragraph they were issued on 1st of January 2019. 1st January 2019. So we say that this liability component is equal to the present value of the annual interest, the present value of the annual interest plus the present value of the principal payment, And actually, you cover similar concept in FM. For example, like when computing the value of debentures, the value of the other debt instrument. Usually, this is a concept you use. You discount the interest to be paid on annual basis and also the principal amount. This is basically not much difference with what you do in financial management. Whenever you're required to compute the value of maybe a debenture, the value of a bond, I think it's basically what you do. So what we need to do here is first of all, we compute this one, the annual interest. So we say the annual interest, in other terms, the interest per annum. How do we compute this? We say the formula is very important because we say that in these questions, you'll be given two rates. You'll be given two interest rates. Which interest rate do we use? We use this one, the coupon interest rate. The coupon interest rate, we say, is the interest name coming before the name of the compound financial instrument. Like the compound interest rate is 7%, and then you multiply that with the par, the face, or in other terms, the nominal value of what? Of the compound financial instrument. So therefore, in our case here, the coupon interest rate, I've said is the interest rate which is given before the name of our CFI, which is 7%. And then still in the first paragraph, the first sentence, we're told the good remitted issued shillings 4 million, 7% convertible bonds on 1st January 2019 par value. So meaning that 4 million is the par value. 4 million is the par value. Remember, this par value can also be known as the face value, can also be known as the nominal value. The examiner may use any of the words here. Yes. So this will give us shillings 280 million. And remember, this will be paid per annum. This one will be paid per annum. So we already have this. So then from there, we need to determine the principal amount. In this case, we say the principal amount. This is the amount payable on redemption. So once these particular convertible bonds mature, how much amount will be paid on redemption? So that information, we have it within first paragraph, the second sentence. We are told the bond is redeemable at par. That is very clear. The amount to be paid on redemption, this one is equal to the par value. So in our case, remember, we know the par value is how much? Is 4 million. So this is the amount to be paid on redemption, and we must be given the date when they will be maturing. So these convertible bonds, they have a life of how many years? So we are told they will be redeemed at par on 31st of December 2023. So that is the redemption date, and basically that will help us in terms of knowing the life of these convertible bonds. Remember, they were issued on this date. 1st January 2019, we are told they will be redeemed on 31st of December 2023. How many years do we have here between those two dates, between the dates they were issued and the redemption date? How many years do we have there? How many years do we have there? We have the first year, which will end 2019, and 31st of December 2019, 2020, 2021, 2022, 2023. 1, 2, 3, 4, 5. Yes. 2019, 2020, 2021, 2022, 2023. And those 5 years all four. They were issued on 1st January 2019. Are they 4 or 5 years? Remember, in this case, the year is supposed to end on 31st of December. Kuna 2019, 2020, 2021, 2022, 2023. Those are 5 years. So the life of these both in 5 years. And remember, in this case, we said when computing this liability component, we assume that the holders will not convert them into ordinary shares. I think we say that is an assumption which we make. That's why you check on that question. There is somewhere we're given information about how they can be converted into ordinary shares. There is no way we use that information here, because we say for us to be able to compute the liability component, we assume they will not be converted into ordinary shares. That's why that information about the conversion, we don't use it here. So we say to discount this, there are two approaches you can use. Remember, this company here, which issued these bonds, which have a life of 5 years, the life of 5 years, our company is expected to pay this amount per annum. To 𝐻 will be paid at the end of each year, and automatically this interest is always payable in arrears. This one is payable in arrears. That is the amount to be paid per annum. That is an annuity. And then at the end of year 5 here, the company will also pay this amount of 4 million. So we said to discount, you can either prepare, for example, a table here from year 1 all the way to year 5, and then you have this amount to be paid. Here you have to 80,000, year 2 to 80, year 3 to 80, year 4 to 80, but year 5, we will have to 80,000 plus 4 million. And then you discount this by multiplying that with the present value, interest factor. And which rate do we use in discounting? When discounting, do we use this 7%? No. In discounting, we say we use another rate, which is known as the effective interest rate or the market interest rate. And I hope you can see that within the last paragraph. We are given the prevailing market interest rate of 9%. So at the rate of 9%, you get those values, you multiply this with this, you get the present values. Alternatively, we said, because this is the 280 is an annuity, so to discount that to 80, we will take 280. We multiply that with the present value interest factor of annuity at the rate of 9%, and basically for 5 years. For 5 years. Then this 4 million, these are lump sum which will be paid basically at the end of year 5. So we multiply that with the present value interest factor at the rate of 9% and basically for 5 years. Remember the formula for getting PVIVA, and this one is different. So here we have 280. So the formula for getting this is what? 1 minus 1 plus R, which is 1.09, raised to power negative 5. We divide that with R 0.09. That is how we compute that PVIVA. And then we add this 4 million. So the formula for getting this is 1 plus R, which is 1.09, raised to power negative 5 by such. Sasa, yes. So let's work out this. We start with what we have here, the PVIVA. So we have 1.09 raised to power negative 5. So 1 minus answer divided by 0.09. That will give us 3.89. Okay, we can, I think we multiply that directly with 280,000. And this will give us 1089. 102. That is basically what I'm getting here. What about this one? 1.09 raised to power negative 5. Is that correct? Can you confirm whether you get that? Yes, so raised to power negative 5 times 4 million. And basically that will give us 25.99 726. 726. Yes, so we add the two values. And I'm getting a value here of 36. 828. That is basically the value I'm getting here. You can confirm whether you're getting the same. Confirm whether you're getting the same. Are you getting the same? Yes, are you getting the same? Are you getting the same? Yes. So that is the what? That is basically the liability component. The liability component. Now, having computed that liability component, step number 2 is to compute something called the equity component. The equity component. And actually, we also compute the equity component on the same date, 1st January of 2019. How do we compute this equity component? We take the cash proceeds. Cash proceeds, remember, we say that is the amount of money which was received. Once the company issued this particular convertible bonds, how much amount did our company receive? That information, we have it within paragraph 1. We told the company Good Limited issued shillings 4 million, 7% bonds at par. They were issued at par. The par value is 4 million. the par value is 4 million. So the amount which was received by our company was 4 million because we are told they were issued at par. They were issued at par. So we take that, and then to this we less what? We less the liability component on the same date, 1st of January 2019. And that is now what you have computed here. This value here, 36, 88, 828.
Data class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of this 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value, So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest, and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is a and annuity, equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year one, you'll receive 300,000. In year two, you're getting 550 or paying or 550. Year three, 600. Year four, 700. Maybe let's say year five, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year one and year two, or period one and period two, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year one and year three, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power n. So future value is equals to 100,000 times 1 plus 0.2 power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. At least repeat your calculation. okay, yeah, on 72,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here, period 1, 2, and 3. Amount, with, let's say 100,000. No, will that give us? No. That is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. we have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do you have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus R power n minus 1 over R. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer, get the answer. $322,080, $322,080. Another person, $322,080. Another person, Alice. Okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power watt, power watt, power watt. So 103,680 must be the first one, 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call okay, fine, Alice, 080. Okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said, this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711, 518. 0.9. 711, 518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we're saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. One 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352. Next, 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711,519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R is we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n the factor 1 plus r power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R% power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172. 800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn 170 to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor R% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we are together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for end periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, no, yeah, present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. what is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper, every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper.
The journal entries to effect the scheme of internal reconstruction. Internal reconstruction. Remember, in this case, we said external reconstruction. This one is also known as the capital reduction. And basically, we say that internal reconstruction or the capital reduction, this entails doing some changes or basically restructuring the company's capital structure. So the company restructure its capital structure, number 1, by writing off all the accumulated losses. Number 2, by reducing the share capital. Also revaluing the assets, and maybe the company trying to reduce some debt. So the company here will restructure its share capital. So now we are required to make journal entries. We are making journal entries for what? We are making journal entries for what was to be done during the internal reconstruction. Now let's go to the additional information, because that's where we have that information. We are told the authorized share capital of 𝐎𝐍𝐶𝐒 Limited. 𝐎𝐍𝐶𝐒 Limited basically comprises of 5 million ordinary shares of shillings 10 each and 1 million 10% preference shares of shillings 10 each. It was decided during the meeting of shareholders and directors of the company to carry out a scheme of internal reconstruction with effect from 1st November 2021 as follows. Number 1, you're told, yes, I think we are recording our session. So number 1, you're told the assets are to be adjusted to their fair value as follows. So the assets now will be revalued to those particular good, to those particular values. So trade receivables 36, inventory 64, machine 2,000, buildings 5,000, and then we are given the accumulated depreciation to be charged. So that accumulated depreciation, basically, which you're given there, basically we need to ignore that, because generally what we know is that you cannot revalue an asset and you depreciate it at the same time. You revalue an asset and then you depreciate it at the end of what? At the end of there. So that was just to confuse you. So we will just work with those particular what? Fair values. So what we need to do is we compare those particular values given in note 1 with the values we have in the statement of financial position of the carrying amount. We determine whether you have a revaluation or actually an increase or a decrease in the value of the asset. We start with the receivables. Receivables in the statement of financial position, its value is 72, but receivables will be revalued to 36. So meaning that for receivables, the value for receivables will reduce from 72 to 36. So we have a decrease of 36. From 72 to 36, that is a decrease of 36. The other asset is basically inventory, which is still part of the current asset. Its carrying amount is 4,000, but it will be revalued. It will be revalued. It will be revalued to an amount of how much? It will be revalued to an amount of what? To an amount of 64. Okay, sorry. I think we are interchanging. So the value for receivables is 4,000. It will be revalued to 36. So mean that we have a decrease of 400. A decrease of 400. So then we have inventory. Inventory will be revalued to 64. The carrying amount for inventory in the balance sheet is 72. So we have a decrease of what? A decrease of 800. A decrease of 800. A decrease of 800 from 72 to 64. Yes. So then from there we have machine. Machine, its carrying amount is how much? The carrying amount for machine is 28. It will be revalued to 2,000. So we have a decrease of 800. We have a decrease of 800. And then buildings, it will be revalued to 5,000. From 6,000, we equally have a decrease of what? Of 1,000. A decrease of what? Of 1,000. Sasa, yes, in that case, I've said both depreciations which are given there, we ignore them. I've said you cannot revalue an asset today and you depreciate the asset at the same time. So you revalue, then depreciate the asset at the end of the year. So therefore, we ignore those depreciations. So basically, it means that the value for all those assets, receivables, inventory, machine, building, their value reduces. How do we account for that decrease in the value of the asset? We said once the assets have been revalued and their value reduces, we need to credit the specific asset account in order to reduce its value. We complete the double entry by debiting the account called the capital reduction account. So therefore, the first general entry here is basically to account for the revaluation of those assets. To account for the revaluation of those assets. So if you check those values, they are basically in thousands of shillings. Okay, so when making the journal entry, let's have the debit column here and basically the credit column. So we always start with the account to be debited. That's basically what we know. The account to be debited is the capital reduction account. And this account will be debited with the total decrease, or actually with the decrease, the total decrease in value for all the assets. We have 400, 800, 800, and 1,000. That will give us a total decrease of how much? That should be 12, 2,000, 3,000. Are you getting a total decrease in the value of assets to be 3,000? To be 3,000. We try to hurry because of time, yes. So then we debit that account, capital reduction account, and then we credit a number of assets. Which account are we crediting? First of all, we credit the receivables account. The receivables account is an amount of 400. We also credit the inventory account. The inventories account is an amount of 800. We credit the machinery account with an amount of 800. We also credit the buildings account. The buildings account is an amount of what? With an amount of 1,000. With an amount of what? Of 1,000. And then in this case, we said, make sure you give a brief narration. The narration will be being a revaluation of assets. Being a revaluation of who? Of assets. Being a revaluation of assets. So we have accounted for the revaluation of assets. Let's move to note number 2. In note number 2, we are told its ordinary share is to be redesignated as a share of 2.5. And then you're told the ordinary shareholders are to accept a reduction in the nominal value of their shares from 10 shillings to 2.5. In addition, the shareholders are to subscribe for a new issue on the basis of 1 share for every 2 shares held at a price of 4. Now, 2 things there. Number 1, we need to account for the decrease in the value of the assets, because we are told the shareholders will accept a decrease in the value of the share from 10 shillings all the way to 2.5. In this case, what we need to account for here is the amount of share capital, which automatically was written off. So the amount of share capital written off, first of all, we determine the amount which was written off per share. If the company is reducing the par value of the share from 10 to 2.5, it basically means that part of the par value has been written off. The amount written off is that decrease. So the value of the share is reducing with how much? Is reducing from 10 to 2.5. The value of the share, therefore, is reducing with 7.5. We multiply that with the shares issued by this company. And in this case, I hope you can see that information deals, note number 2 deals with the ordinary shares. So we go back to the balance sheet of this company, specifically at the equity. That's where we get the shares issued. So how many shares were issued by this company? We take the equity share capital or the ordinary share capital, which is 20,000. Remember, these are not shares. This is the share capital. How do we get the number of shares? We divide that with the par value, which is still in the balance sheet at the equity. I hope you can see the word equity shares of shillings 10 par value. So therefore, the shares issued by this company are 2,000. We multiply that with 7.5. And that basically will give us what? That will give us what? Will that give us 15,000? 15,000, the amount of share capital which is written off. The amount of share capital which is written off. Yes. So how do we account for that? How do we account for this? Remember, we say in case we want to reduce the share capital, remember share capital has a credit balance. So if we want to reduce this, we debit that account. We debit share capital. We complete the double entry using the capital reduction account. So therefore, in this case, we will debit the equity share capital account, with the amount which was written of 15,000. And then we complete the double entry by crediting the capital reduction account with the same amount of 15,000. The same amount of 15,000. What is our narration here? Our narration is being the share capital, which is written off. So what we have accounted for here is the share capital, which is written off, being the share capital written off, So in the same point, number two, we are told, other than the company writing off the value of each share, we are told that existing shareholders of the company will subscribe. To subscribe is to buy. If you buy shares of the company, you pay for those shares. So in this case, we are told they have to subscribe, they have to buy a new or basically new shares on the basis of one share. So these are the new shares to be issued. New shares to be issued. And basically I've said that these are shares to be issued in cash. The existing shareholders will buy some shares. So they are to subscribe new shares on the basis of one share, for every what? 2 shares which are held, for every 2 shares which are held. Now, how many ordinary shares are currently held? From what you have done up here, how many shares are currently held by the existing shareholders? The shares currently held, yes, we have said are 2,000. So these are the shares which are currently held. So we just cross multiply, then we divide, so that we determine how many shares are currently held. Sorry, how many shares will be issued, not held. So the shares to be issued will be 1 times 2,000 divided by 2, and basically this will give us 1,000 shares. And then we are told each share will be issued at 4 bob. Each received here would be 4,000. So how do we account for this particular amount received by the company? How do we account for that amount received? Number one, because this money was received, the shareholders paid for that money, we debit the bank account. Remember, this money received, we debit bank, and then the company issued shares. So we credit the equity share capital account. Remember, the amount credited to be credited in this account always has to be based on the par value. Now, what is the new par value per share? What is the new par value per share here? What is the new par value per share? The new par value per share, Ningapi. The new par value per share is 2.5. Remember, it was previously 10. It has been reduced to 2.5. So therefore, the amount to be credited in this account will be based on the par value 2.5 times the shares issued. The shares issued were 1,000. So the amount credited in this account is 2.5. Now, it automatically means that because the shares were issued at 4 bob, the shares were issued at a share premium. We said whenever we are accounting for external reconstruction and shares have been issued at a share premium, that share premium is not taken to the share premium account, but rather we credit it in the capital reduction account. Sasa, yes, that amount we will not credit it in the share premium account, but basically we credit it in which account? The capital reduction account. And automatically that should be the difference here. That should be the difference 15. So we give a brief narration being issue of additional shares, or maybe being issue of shares for cash. So we are done with that. Let's move to point number 3. We are told the existing preference shareholders are to be exchanged for a new issue of 6 million, 15% preference shares of shillings 10 each, and 800,000 ordinary shares of shillings 2.5. So it basically means that if we go back to the balance sheet of this company, specifically at the equity, you'll see this company had issued 12%, not 12%, rather 10% preference shares. So the preference shares issued by this company, they have a value of 8,000. So we are told the holders of these particular shares will be required to surrender them back to the company. In exchange of what? In exchange of 6 million. In exchange of 6 million, 6 million. Preference shares having a value of 10, and 800,000 ordinary shares, 800 ordinary shares, each share having a value of 2.5. Yes, and I think usually this question, there is a small typo, a small typing error. So this particular amount here, you see this amount here, 6 million, that's 6 million, that should be shillings. Because you can see that these preference shares currently issued by the company, they have a value of 8 million. So automatically, once they are required to surrender them back to the company, they are required to surrender these shares back to the company, they must be issued with other shares or even debentures having the same value, having the same value. So if you take 6 million times 10, because you can see, take into account we don't have the word shillings before 6 million. We can only take 6 million to be the shares. So you should take the share 6 million times 10. That will give us 60 million. You can see that one is more than that. So that's why I'm saying there was a small typing error. This one should be shillings. If you have the physical paper, so before the word 6 million, we should have 6 million. The issue of 6 million, 15% preference shares of shillings 10, and 800,000, 2.5, or ordinary shares of 2.5, such that if you work out this now, you work out this 6 million, and then these ordinary shares which were issued 800 times 2.5. So if you multiply these two, this will give us what? Is it 2,000? 800,000 times 2.5. Is it 2,000? Yes, it should be 2,000. Such that if you add this and that, that should give us 8,000. So these preference shares which were issued and these ordinary shares which were issued, they must be having the same value, because the old shares, the old preference shares which have been issued are to be exchanged with the new shares. Yes, so that's why I've said there was a small typing error as far as that question is concerned. Now, what we need to do here is, number one, we cancel these shares. We cancel these shares. How do we cancel them? We cancel them. Remember, this account has a credit balance. So to cancel this, we will debit this account, and then we go ahead and basically debit to account. We debit this account for the new preference shares which were issued, and also we credit. That is to credit that account, and also we credit ordinary share capital. So we debit the 10% preference share capital, and then we credit to account. So we are canceling the old shares and accounting for the new shares which were issued. So we debit the 10% preference share capital account with an amount of 8 million, or basically 8,000, and then we credit these preference shares which were issued. They were 15%. We credit 15% preference shares, preference share capital account with the 6 million, and then we credit equity share capital with an amount of 2,000. Yes. So what is the narration? Being the old preference shares which were cancelled. Yes, and I think we are done with that particular point. Let's move to point number 4. In point number 4, what are we told? We are told that the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 each in lieu of interest payable. Then you're told the 12% debentures are to be converted to 14% debentures. And then you're told a further shillings 2 million or 14% debentures of shillings 10 each are to be issued and taken up by the existing debenture holders at 90 shillings per debenture. So in that case, I think we have like 3 transactions we need to account for. Number 1, let's account for what we have in the first sentence. We are told the debenture holders are to accept 200,000 ordinary shares of shillings 2.5 in lieu of the interest payable. It basically means that the interest which was supposed to be paid to the debenture holders was in arrears. So instead of the debenture holders being paid that interest which was in arrears, instead of being paid that interest in cash, they will be issued with the ordinary share of the company as a form of a payment. So first of all, we need to determine How much was this interest, or how much was the interest in arrears? That one is in the balance sheet of the company below paragraph 1 and specifically under equity. Can you be able to see the interest payable on debentures or the interest payable to the debenture holders under the equity? Under equity, yeah, that one should be 720, not 2000. Should be 720. So basically, what we need to do, remember that is a liability. So being a liability, we are told this amount automatically will be paid. How will it be paid? It will be paid by the company issuing shares. So we need to first of all cross off this account. Because the liability has a credit balance, how do we cross that account? We debit that account. So the journal entry number 5 is to debit that account. We debit the account called interest payable on debentures with an amount of how much? 720. And then the debenture holders here will be paid by being issued with the shares. So how many shares will be issued to the debenture holders? The debenture holders, in that case, we are told as per note number 4, they will be issued with 200,000 ordinary shares over 2.5. Of 2.5. Automatically, if you multiply these two, that one will give us 500,000. 500,000. So what happens, or what is the difference now here? You can see the amount which was to be paid 720, but the shares issued, they had a par value of 500. What happens to the difference? And remember, the amount to be debited has to be equal to the amount to be credited. Yes, the difference is the share premium. Do we take it to the share premium account? No. So we have said any share premium, any shares which are issued at a premium, any share premium is taken to the capital reduction account. So the difference here, which is 220, is the share premium. But do we credit it in the share premium account? No. We credit it in the account called the capital reduction account. Capital reduction account. So we can say in the narration, being payment of accrued interest. Being payment of accrued interest. So still in the same point, we are basically done with that. Still in the same point, sentence 2, we are told that the 12% debentures are to be converted to 14% debentures, just like what we have done here. So what we need to do is we need to cross off the 12% debentures account. If we go back to the balance sheet of the company here, under equity, you'll be able to see that our company had issued 12% debentures. 12% debentures. We are given their value. We know debentures is a liability. So this account should have a credit balance. So these debentures are to be exchanged, to be converted, that is, to 14% debentures. What does that mean? It basically means that we need to cross off that account by debiting it, and then we open another account called 14% debentures. So this account, we credit it with the same amount. So we debit the 12% debentures basically to cross off that account, and then we credit the 14% debentures account. So what is the value of these 12% debentures from the balance sheet of our company? The 12% debentures, they had a value of 6,000. So in other terms, we have converted the 12% debentures into 14% debentures. So narration, being conversion of 12% debentures into 14% debentures. Being conversion of debentures, or you can just put it like that. Remember that narration has no mark, but it's always good to give a narration of what you have accounted for. Sasa, yes. In the same point, we also have other debentures which were issued in cash. In the last sentence, a further shillings 2 million 14% debentures of shillings 100 are to be issued and taken up by the existing debenture holders at 90 bob. So these are new debentures to be issued. The 14% debentures, we are told having a value of 2 million, having a value of 2 million. But in this case, we are told their par value is 100, but basically they will be issued at a discount. They'll be issued at a discount because we are told they will be issued at 90 bob. So basically what that means is that our company here, instead of receiving 2 million, the cash to be received, the cash received will be what? Will be 90 all over 100 times what? Times 2 million. In other terms, because they have a value of 100, but they will be issued at 90, it's like they were issued at a discount of 10%. Sasa? Yes. So the amount to be received should be equal to what? should be equal to 90%. Because they were issued at a discount of 10, the company received 90% of 2 million, which is 1.8. 1.8. So that is basically the amount to be received. How do we account for this amount received? The amount received, number one, this one will be debited in the bank account. We debit the bank 18 with the cash which was received. With the cash which was received. Now, the difference which is, or actually the discount which is 200,000, which is the discount, that one, basically we take it to which account? We take it to the capital reduction account. We must account for that discount. So that discount is 200,000. We take it to the capital reduction account, because by the end of the day, the amount to be credited in this account, the amount to be credited in the 14% debentures, 14% debentures, just like what you have said in relation to the shares, that one has to be based on the par value. Remember, the par value is 100. So the amount to be credited in this account has to be based on the par value of 100. So meaning that the amount to be credited in this account should be 2,000. It has to be based on the par value, just like the shares, just like the shares. So the narration being an issue of debentures for what? For cash. Being issue of debentures for cash. We are basically done with that. So let's move to the other point, number 5. In note number 5, we are told shillings 800,000 of the loan from directors is cancelled, and then you're told the balance of the loan is to be settled by the issue of 200,000 shares of shillings 2.5. So first of all, can we go back to the balance sheet of this company? We check how much was the loan from the directors. The loan from directors, that has to be either below as a liability, basically. The loan from the directors is a liability. Yes, and I can see that that one is given together with the share capital. So the loan from directors is basically 2,000. So what we are told in note number, let's go back to note number 5. We are told 800,000 of this shillings 800,000 will be cancelled. In other terms, it will be written off, whereas the balance is to be settled by issue of shares. So the balance will be settled by issue of shares. So how do we account for that basically? Remember, this account loan from directors is a liability account. So being a liability account, the account has a credit balance. So part of this amount is to be written off. We debit it here. The amount written off, we debit it in that account. Then the balance, which is basically 1,200, this one will be settled by the company by issuing shares. By issuing what? Shares. So therefore, we make a journal entry for that. So we debit this account, loan from directors. First of all, let's account for this amount which was written off. Loan from directors. Loan from who? Directors. We debit that account with 800,000. So automatically the other entry will be in which account? Will be in the capital reduction. No, let's do this. This account basically we debit it with the total amount, because the full amount will be written off. Will be written off. But now when accounting for this amount which was written off, remember this amount will be debited in this account and then credited in which account? And that amount which was written off will be credited in the account called the capital reduction. This is the amount which was written off, the loan which was written off. It will basically be debited here, credited in which account? Capital reduction. Then this amount which was paid through the issue of shares, I hope you can see the number of shares which were to be issued to the directors. The directors were to be issued with how many shares? Are we given the number of shares which were to be issued to the directors? Yes, the directors were to be issued with 200,000 shares. 200,000 shares, each share having a value of 2.5. So if you multiply these 200 times that basically will give us 500. But you can see the amount which was to be paid by the company through the issue of shares, Ningapi, the amount which was to be paid through the issue of shares was 1,200. It also means that these particular shares which were issued to the directors were issued at a premium. Is that the position? Are they issued at a premium? Yes, because you can see the amount which was to be paid was 12, but the par value of those shares is 500. So therefore, what will be the double entry for that? We will credit the equity share capital with the shares which were issued, which are 200 times 2.5, basically that will give us 500. So the difference between 500 and 12 will be a share premium. Where do we take the share premium? To the capital reduction account. To the capital reduction account. Remember, that is the share premium. That is the share what? The share premium on the shares which were issued. So by the end of the day, if you add this, the amount to be credited, the amount to be what? The amount which has been debited, you'll be able to see the amount is the same. So 800 plus the 500, which is 13, plus 700, 2,000, which is equal to that. So this is our narration being director's loan, which was cancelled, director's loan cancelled and paid. So we have accounted for the director's loan which was cancelled and the one which was paid. We are basically done with that. So then let's move to the other point, number 6, and I hope you're together up to that point. I hope you're together up to that point. Are we together up to that point? Can we move to point number 6? Yes, we are together up to that point. So in point number 6, you're told the investment are to be sold at their current market value of 6 million. So which are these particular investment? Investment automatically should be an asset. So if we go back to the balance sheet of this company, below the non-current assets, I can see we have intangible assets. One of the intangible assets is investment. The value for investment is 45. So we are told that investment, as per note number 6, we are told that investment will be sold at the current market value of 6 million. So the investment will be sold at a profit, because if you take the carrying amount of that investment is 45, but the investment will be sold at 6,000. So that profit, that gain on the sale of investment, that one automatically we cross it off, we take it to the capital reduction account. So first of all, we account for the amount which was received. The amount received, that one is debited in the bank. So how much amount was received? It should be equal to the sales proceeds. Sales proceeds is what we have in note number 6. Our investment was sold at 6 million. That is what we debit in the bank. That is what we debit in the bank. And then the amount which we credit in the investment account should be equal to the carrying amount. Investment was recorded at 4.5. We credit that account with 4.5. The difference, which is basically 15, we are saying is the gain on the sale of investment. So that gain on sale of investment, where do we take it? We take it to the capital reduction account. To the capital reduction what? Account. So the narration here is being what? Being investment sold. Being investment which was sold. Being investment which was sold. Being investment which was sold. We are basically done with that. Let's move to point number 7. You're told bank overdraft was paid in full. Also very simple. Bank overdraft, we know, is a liability. Is a liability. So if bank overdraft was paid and is a liability, we need to cross off this account by debiting that. We debit that account, we credit bank account. So we debit bank overdraft account. Bank overdraft, this one has to be part of the current liabilities in our balance sheet. And the bank overdraft is basically 3,000. And then we credit bank account with an amount of 3,000. So the narration here is being payment of bank OD. 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 Yes. So we are done with that point. Let's move to point number 8, and we are told a sum of 3.18 million is to be paid off, to offset the sundry payables immediately, and the balance in 4 equal installments at the end of each quarter. So I think in our case here, what we need to do is to account for the amount of payables which was paid, or the amount of sundry payables which was paid. So that one is basically quite simple, because what you just need to do is to, once a liability has been paid, we debit the liability account. So we will debit the payables account, or actually the sundry payables, which is basically part of the current liabilities. Sundry payables with the amount which was paid as per note number 8, 3180. that 180, and then automatically we do what? We credit bank. We credit bank. I hope you can be able to see down there. That one what? That 180. That one what? 80. That 180. Then we need to give a brief narration for that. We need to give a brief narration. A brief narration for that. A brief narration for that. So being payment or being partial payment, being partial payment to who? To creditors. Being partial payment to creditors. Being partial payment to creditors. Being partial payment to creditors. Yes. So we are done with that basically. Then we are told the balance will be paid in 4 equal installments. Are we interested with the amount to be paid in the remaining amount to be paid? No, because if you check on what you're told in part B, we are required to prepare the balance sheet of this company immediately after effecting this. So not even after a quarter, not even after a day, immediately after the company effected this. So we are not interested with the amount to be paid in the those quarters. Yes, we are not interested with that. Then number 9, we are told all intangible assets are to be eliminated. Being eliminated means that all the intangible assets will be written off. Will be written what? Will be written off. So I need to create some space here. Yes, so all the intangible assets will be written off. Which are those intangible assets? Automatically, it is all the intangible assets excluding investment. Remember, investment was sold. So we need to write off goodwill and patent and trademark. So how do we write off assets? So can we credit the asset account because assets have a debit balance? We credit the asset account. We debit the capital reduction. We debit the capital what? The capital reduction. So this should be journal entry number 12. We debit capital reduction account. Capital reduction account. Capital reduction account with the total value for the 2 assets. Goodwill 6,000. Patent and trademark 500. That will give us a total of 65. And then which account do we credit? We credit goodwill with an amount of 6,000. We credit patents and trademarks with an amount of what? With an amount of 500. Narration being intangible assets, being intangible assets which were written off, or maybe which were eliminated. Being intangible assets which were written off, or being intangible assets which were eliminated. Yes. So we are done with that. Then note number 10, we are told it is estimated that under the new arrangement, yes, now that information which we have in note number 10, that one will be used in answering part C. Do we use that in making the journal entries? No. That one will be used in answering part C of the question. So we are basically done, but there is something here we must always remember to account for, even if that information is not provided by the examiner. Remember, this company is trying to clean its books of accounts. Whenever the company is doing internal reconstruction, the company has to write off any accumulated losses. Even if that information is not given to you by the examiner, you must remember to account for that. You must write off the accumulated losses. So if you go back to the balance sheet of our company, specifically at the equity, you'll be able to see that the company had accumulated losses of 5.8. That accumulated losses has to be written off because the company cannot do internal restructuring and still the books of account remain with accumulated losses. That has to be written off. So how do we write off these accumulated losses? So remember, this account always has a debit balance. It is the retained earnings account which has a debit balance because those are losses. How do we write off that account? We credit it and then we debit the capital. We debit the capital reduction. We debit capital reduction account with accumulated losses of 58. And then we do what? We credit. We basically credit the accumulated losses account. Accumulated losses account with the 58. So what is the narration here? Narration is being accumulated losses. Being accumulated losses which were written off. Being accumulated losses which were written off. And I think in our case, basically we have done with preparing what was required. So in part A, that basically what was required. So by doing this, the marks are located here. Basically what? are basically 10. In most of the cases, you'll see that the max allocated here is half for every correct entry, half. So it basically means that you needed like 10 items, not 10 other, 20 items, 20 correct entries here. And basically you get the 10 allocated what? 10 allocated marks. Now, if you can be able to recall the other question which we did in class, after this, the examiner basically was requiring us to prepare the capital reduction account. Even though it is not a requirement in this question, can we prepare the capital reduction account? Let's prepare the capital reduction account, even though it is not a requirement here. Even though it is not what? A requirement. So let's prepare that account. I want to create some space here. So, but basically we have to remember here, our capital reduction will be debited with a total of 3,000. Yes. So let me create. So we prepare the capital reduction account. Capital reduction. Capital reduction account, capital reduction account. Yes, journal entry number 1 up to journal entry number 13 as you check what is affecting the capital reduction. Journal entry number 1, our capital reduction account is to be debited various items. So the first entry comes from the account called the trade with an amount of 400. The other entry is in the inventories account with an amount of 800. The other entry is in machinery account with an amount of 800. And basically the other entry is in buildings account with an amount of how much? With an amount of 1,000. So that those particular amounts are debited in this account and then credited in the respective account. In the respective what? In the respective account. In the respective what? Account. Then we go to the journal entry number 2. We check whether the capital reduction account is affected. Yes, capital reduction account, you can see, it's supposed to be credited. The other entry, so this account we credit this. So the other entry is in equity share capital account with this particular amount, 15,000. Journal entry number 3, is the capital reduction account affected? Yes, capital reduction account is to be credited with 15. So the other entry is in bank. That also affects capital reduction. Does this affect the capital reduction? No. Journal entry number 5, is the capital reduction being affected? Yes, capital reduction account is to be credited. The debit entry is in the interest payable on debentures, which is 220. So then this journal entry capital reduction is not affected. Here capital reduction is to be debited. The other entry is this account is to be debited. The other entry is in 14% debentures with an amount of 200. I can do away with this basically. Yes, so then from there we have the other journal entry here. This one. So the capital reduction account will be actually credited with a total amount of 800 and basically 700. I think we can combine that here. So that will be a total of 1,500 to be credited. This account will be credited. The other entry is in the account called loans from directors with a total of 1,500. That plus that, which will give us 15. So then from there, journal entry number 9. So the capital reduction account is supposed to be credited with 1,500. So the other entry is in bank account. Journal entry number 10. Journal entry number 10 here. Capital reduction account is not affected. Journal entry number 11. Capital reduction is not affected. Journal entry number 12. Capital reduction is supposed to be debited. One of the entry is in goodwill account with an amount of 6,000. The other one is in patent and basically trademark 500. And then finally, journal entry number 13, capital reduction account will be debited with an amount of 58. So the other entry is in the account called what? The accumulated losses account. And basically we are done. So remember, you say that this account should either automatically balance or should either balance of all, we have a balancing figure on this side, which is called the capital reserves. The account should either balance off, or basically we have a balancing figure on the debit side, which is known as the capital reserves. Yes, so can we do that? Can we determine whether account is balancing, or basically we have what? We have a debit balance. That is basically what I'm getting on the credit. Yes, that is basically the figure I'm getting. Yes, so that is also what I'm getting from Ismail. Is that what you have? A balancing figure on the debit side. A balancing figure on the debit side, which is called what? The capital reserve. Is that what you have? Is that what you have? I hope that is what you have. I hope that is what you have. I hope that is what you're getting. Yes. Yes. So basically that is it. What we need to do is we basically move and prepare what is required in part B. What is required in part B? What is required in part B? What is required in part B? In part B, I think maybe first of all I can give you a small breather, and then we come back having a lot of energy. We finish on what is remaining. So let's just take a small breather. We come back at 9:25. We continue. So a small breather, then we come back. Yes. So I want us to continue. Let's continue. Let's continue. I hope you're back. I hope you are back. Yes. So let's continue. I want us to go straight to preparing what is required in part B of the question. And basically, the examiner was requiring we prepare statements of financial position immediately after the internal reconstruction. Statement of financial position. This is as at 1st November 2021. 1st November 2021. So we just need to have a single column here, and we start with the non-current assets. So the non-current assets, we start with basically what you need to do when preparing this. You should be guided by the original statement of financial position. In the original statement of financial position, we have land, buildings, machinery, intangible assets. So number one, we know that land was not revalued. The value for land remained the same. Land was not revalued, and basically its value was 8,000. Then below that we have buildings. Buildings, we record the value which we have in note number one. Buildings. We have, someone is asking, we go back to the general entries. Let's first of all we finish this one. Then maybe I'll see. So buildings was basically valued as per note number one, and basically the value for buildings is 5,000. Is 5 what? 5,000. 5 what? 5,000. 5,000. Yes. So then still in our statement of financial position, below buildings we have machinery. So basically machinery were valued as per note number one, and the value for machinery is basically 2,000. 2,000. So then below machinery, now I've said we are using the original statement of financial position. So below machinery, what do we have? Intangible asset. We know investment was sold. Will it appear here? No. We know goodwill and basically patent and trademark were written off. They will not still appear here. So mean that all those particular intangible assets will not appear there. So then from there, we move and basically record the current assets. Current assets. So for current assets, we start with, basically we have two current assets. Actually three current assets in our statement of our financial position. We have the first one, which is inventories. Inventories were valued as per note number 1 to an amount of 64. We record inventory here at 64. Then also we have receivables. Receivables were valued as per note number 1 to a value to an amount of 36. To an amount of 36. Still, in our statement of financial position, we have cash. Cash, this will not change. Not change because all the other amounts which were received by the company, we have assumed they were received through bank, or any payment which was made by the company, we have assumed it was made through bank. Automatically here, we will have to prepare the bank account and basically determine what is the bank balance, because there is automatically money which remains in the bank balance. And actually, instead of preparing the account, we can have that working here directly because we know what was received, what was paid. So I think we just need to go through journal entries number 1. There was no any amount there was nothing affecting bank in journal entry number 1. Journal entry number 2, there were those particular shares which were issued for cash. The shares which were issued for cash, they had a value of how much? Just go to the shares which were issued for cash and you give me that amount. We try to vary because of time. Was it 4,000? Was it 4,000? 4,000? Yes, 4,000. 4,000. So this is basically money received. So we will take all the money received as positive, any payment as a negative. So we have that amount which was received as per note number 2. Note number 3, no cash which was received. Note number 4, we have the amount which was received from the issue of debentures, and that amount was 1,800. The amount received from the issue of debentures, is it 1,800? Yes, 1,800. Amount received from the issue of debentures, as per note number 4, please confirm. I can remember it was 1,800, the amount received from the issue of debentures. Then from there we have note number 6, the investment which was sold at 6 million. So this is the cash received, 6,000. Then we have note number 7, we have payment of an overdraft, that is minus. The overdraft was 3,000. The overdraft was 3,000. Then we also have note number 8, the payment to the creditors, that 180, which is still a negative. That 180 is a payment. Yes, I don't think we have anything else. That should give us the bank balance. That should give us the bank balance. The bank balance, I hope that is the figure I'm getting from Patrice, of 5620. Because the total amount received should be 10,000 plus 18, that is 11,800 minus 6180. Yes, so that one should give us what? Should give us 5620. Yes, I don't think we have any other asset here. And basically we say no need of even getting these totals. We say these totals are not marked. So just move and you record equity. So for equity, we will also be guided by our original statement of financial position. So first of all, we have equity share capital. Equity share capital. We know this equity share capital will change. So the original share capital is basically 20. Instead of preparing the ledger account, let's just do the adjustment here. So then we go to the notes, and basically whatever is affecting share capital, we adjust it here. Ordinary share capital. So we have note number 1 is not affecting this. Note number 2, we have the amount of share capital which was written off. The share capital written off reduces this. So the share capital written off, I can remember, was 15,000. This is the share capital written off. We deduct it from 20,000. Then we also have the shares which were issued as per note number 1 in cash. And whatever we add here is the par value. Out of the shares which were issued for cash, the par value for those shares is 25. Is that the position? The amount credited in the share capital? For your case, you can check that from the journal entries. You can check that from the journal entries you have. You check what is affecting ordinary share capital. That's that? Yes. So if it is a debit, it is to deduct that amount here. If it is a credit, is to add. So then, and accounting it, or actually number 2, we have an amount of 15,000 written off, and the shares which were issued at 25. Then note number 3, we have the shares which were issued, whose value is 2,000. We add 2,000. We add 2,000. We add 2,000. So then journal entry number 4. Do we have shares which were issued there? Yes, the shares which were issued in lieu of interest, and basically they were 2,200 times 2.5. Basically, which will give us what? 500. Yes. What about journal entry number 5? So we have the loan paid to the directors. Yes, we have the shares which were issued to the directors. The shares were 200 times 2.5, and I think that will also give us 500. I hope that is still correct. Yes, and then we have note number 6, 7, 8, 9. I don't think we have any other transaction affecting ordinary share capital. What should be the final figure for the ordinary share capital? That should be 575, 45, 55. Is that the position? Yes. So this is the 5,000, 75, 95, 10,000, 10,500. 10,500. Yes. So then from there we have this capital reserve. This capital reserve, we have it here as a component of reserve, capital reserve, which is basically an amount of 4220 capital reserves. Then we still go back to our original balance sheet and we check what else to be included here. We have 10% preference shares. Those 10% preference shares, I hope you can remember, they were cancelled as per the information we have in note number 3. They were exchanged with 15% preference shares. So here we will have 15% preference shares, or basically 15% preference share capital. So the preference shares, as per note number 3, basically will be having a value of 6 million. A value of 6 million. Value of 6 million. 15% preference shares. Yes. So then from there we go back to our original balance sheet. We have debentures. I think those debentures we can now classify them as non-current liabilities. So then from there, still at the original balance sheet, we have interest payable on debentures. Will that appear here automatically? No, because I hope you can remember that amount was paid. The loan from directors will not appear here. It was part of it was written off, part of it was cancelled. The accumulated losses still will not appear here. So all those items will not appear here. So then from there we can move and basically we record non-current liabilities. Now for the non-current liabilities, we will have debentures, but I hope equally you can also be able to recall those debentures, 12% debentures in our original balance sheet. As per note number 4, they were converted to 14% debentures. Now we have 14% debentures. So the value for 14% debentures, one, this 12% debentures, they were converted into 14% debentures. So what was the value of those 12% debentures? The value for 12% debentures is how much? Is basically 6,000. But also remember, as per note number 4, there were other debentures which were issued by the company having a value of 2,000. So in total, the 14% debentures will be having a value of 8,000. A value of 8,000. The ones which were issued in exchange of the old debentures and the ones which were issued for cash. Sasa? Yes. So then from there, do we have any other non-current liability which will appear here? Any other non-current liability which will appear here? I don't think so. Finally, I think what we have now are the current liabilities. So in that statement of financial position which we have here, we have bank overdraft. Automatically that will not appear here because it was paid. Then we have sundry payables. Sundry payables was supposed to be paid 51.80, but remember there was part of the amount which was paid to them as per note number 8. They were paid 31.80. So the amount which they were to be paid, or the balance was how much? Was 2,000. I think basically that's what we have. I don't think we have anything else. Yes. And automatically, once you balance out your statement of financial position, it should balance, but no need of getting those totals. No need of getting the totals. No need of getting the totals, which basically will be marked are these entries. These are the entries which are marked. These are the entries which will give you the marks. These entries there, not the totals there. These are the entries which are marked. Basically, the marks allocated there were 8. Now, I want us to finalize with the last part. Let's do the last part of the question. This is a very good question on internal reconstruction, a very good one, because you can see that it has so many entries, or basically so many items being tested in that particular question. So it's a very good question on internal reconstruction. So let's do the last part of the question. And basically what we are required to do is we prepare a statement showing how the anticipated profit will be distributed among the various providers of capital. In other terms, you can just refer to this as the distribution statement. Distribution what? Statement. So these are statements to show how the anticipated profit will be distributed among the shareholders. So I said the information which we have in note number 10 is what we're going to use in answering this part, together with some of the information which we have here. Together with the information which we have here. Can we go to note number 10? We see what we are told. We are told that it is estimated that under the new arrangement, the net profit before interest and tax will be 5 million shillings, 5 million per annum. There will be no tax liability relating to the company for the next 5 years. So basically, we are required to show how that profit will be distributed to the various providers of capital.